All right, welcome everybody. Thank you so much for joining us. This is Scaling Your Real Estate Portfolio by Investing in Apartment Complexes. I'm Sean McKay with American IRA, and today I'm extremely excited to have with us Mr. Christopher Larson, who is the founder and managing partner of Next Level Income. Chris, thank you so much for being with us.
My pleasure, Sean. Thanks for having me today.
Absolutely. So, for any of you who have listened to our webinars previously, you understand that for us to bring on a guest speaker to dig into a particular topic that has some sort of relevant relationship to self-directed retirement accounts, we're always very particular and careful about that individual in that group that we bring on. And I'm not even sure if actually Chris is aware of this, but Chris has been definitely a mentor of mine, and I consider him a friend. I've known Chris for probably at least 7 or 8 years now, and Chris is an incredibly knowledgeable real estate investor. And frankly, I've learned a good bit from him as it pertains to sales and business development and how to think about those concepts that has been useful at American IRA. So Chris is someone that I automatically think of when I think of resources for our clients and our potential clients as it pertains to learning about apartment complexes. So this is really an exciting webinar for me. I think there's going to be a lot of value for those of you that are listening. So just a little bit of housekeeping. We do have a questions box on the tab here. If you're listening to this live, please feel free to type in any questions you have. And at the very least, we'll certainly dig into those at the end of the presentation. As I mentioned, obviously, I find Chris to be a tremendous resource. But just to be clear, American IRA is not promoting any particular product, service, or opportunity. We just simply brought Chris on as an expert on a specific investment strategy of apartment complex investing so that he could kind of bring us up to speed and help us to understand some of the fundamentals of how he analyzes apartment complex deals that he's investing in. So the first 10 minutes, we do have a lot of non-clients listening to this. So the first 10 minutes will be revolving around the self-directed concept, kind of the very fundamental aspects. And then I'm going to turn it over for the main event so that Chris can get us up to speed on this apartment complex idea that's really an exciting world. It's an interesting world, and something we hear a lot about from current clients and non-clients wanting to hear more and more about. So we'll just go ahead and dig right into it with the self-directed aspect. So as we think about retirement accounts, I think so many of us are familiar with the stock market, with different products that we can invest in with our IRAs and 401ks. So whether it's individual stocks, whether it's mutual funds or ETFs or bonds, that's certainly a concept that is very familiar to us with our IRAs and 401ks. Now, ultimately, as we look at kind of the society as a whole, what nationally is being invested in, 90+% of IRAs and 401ks currently are being invested in different bank products such as CDs and money markets, or they're some way invested in the stock market with mutual funds and individual stocks and products like that. And I'm the first one to say that those can certainly be quality wealth building tools for us. I have a lot of respect for that industry. My dad was an advisor for 35 plus years, and so I can really appreciate that that can be a great tool for many investors. For me, as a smaller investor, I find that there are a few challenges for many of us as we're thinking about how to allocate our IRAs and 401ks. And so for me, the first thing is just an understanding of that asset class and what it takes to be a successful investor. Now, I'll be honest with you, I'm the first one to admit I'm actually the type of investor that will actually dig into annual reports for individual companies prior to making investments with those companies. I'll do the work, and ultimately what I find is that I still end up kind of lagging in terms of performance versus what I'm able to do in the real estate market, or even frankly just with index funds and kind of very passive tools. And so I think the challenge for so many of us is that it can be a very complicated and confusing type of investment to make. And so ultimately, as we all know, the best results are going to come from investing in opportunities that we truly understand. And unfortunately, for so many of us, we don't understand the stock market and all of the different levers and elements that go into fully comprehending either the individual company or a basket of companies in a mutual fund. The second concept that I think has always been a little bit frustrating for me as it pertains to the stock market is the lack of cash flow that we get from these types of investments. And so when I think about kind of what you hear in terms of people working and saving their money and investing over decades, they're looking to typically acquire some sort of substantial portfolio. So for some of us, that might be a $500,000 portfolio. It could be $1 million portfolio. But when you think about the cash flow that those substantial portfolios produce, again, it's really pretty disappointing. So for those of us that love those index funds and those really passive tools, most of the time, the actual cash flow that's produced, the dividend yield, is usually even less than 2% on our investment capital. And so if you look at a $500,000 portfolio of stocks and mutual funds, that's going to give us about $10,000 a year in income if we're assuming a 2% yield. And so ultimately, for many of us, that's not going to allow us to retire and certainly not do it in the way that we want to. And as many of you have seen, even prior to the pandemic of 2020, we're now seeing fewer people that are paying into different structures such as Social Security as in relation to the people that are actually being able to pull out as they're in their retirement years, the baby boomers and that age group. So that really leads us to believe that Social Security may have to be reworked at some point in the future. So ultimately, as we think about our investment portfolio, to me, that leads me to wanting to invest in an asset class that's a little bit more understandable, and ideally an asset class where there's the potential to get a better return on my investment dollar as opposed to making 1 or 2% off of my mutual funds or my individual stocks. So ultimately, I think that's why so many of our clients are interested in that real estate asset class, because of that potential with rental income from making loans to get an above average return from a cash flow standpoint on what we're investing in. So when we hear the term self-directed retirement accounts, to me, there are two concepts that we should all be clear on. The first is that, as the name indicates, these are retirement accounts where you, as the account holder, are directing your investments. These are self-directed. So at American IRA, we are not financial advisors that are picking products for you. We are just simply giving you the opportunity to invest in what you understand and what you think is appropriate for your portfolio. Now, ultimately, clients can still invest in securitized products with us. They can invest in their stocks, their bonds, their mutual funds through a TD Ameritrade platform that's in-house, if you will. We have a relationship with them, so you can have a portion of your portfolio with them to do your trading, your index funds, whatever the case may be. But ultimately, clients are coming to us because they're interested in alternative investments. And so that can be anything from the direct ownership of real estate to being the bank and actually lending money to other real estate investors so that they can do their projects, whether it's rental properties, fix and flips, whatever the case may be. There's also the opportunity to invest in privately held companies. So again, we're talking about the stock market, these big, huge conglomerates, these multinational firms with so many moving parts and layers to the companies. But you might find somebody in your own community that you're interested in investing in their perhaps smaller, less complicated business. Maybe it's a restaurant that's starting up. It can be really anything that you think has a high probability of being successful. We're also starting to see a lot more clients that are investing in assets like digital currencies, like Bitcoin, for example, and also precious metals such as gold and silver. So, interestingly enough, the way the IRS code is written is it simply tells us what we cannot invest in, which is basically just collectibles, life insurance policies, or investments into S corps. And so ultimately, you're able to extrapolate from that. There are so many opportunities for us as investors with our IRAs and 401ks. So at American IRA, we are actually considered a fully integrated financial services company. And so what that means is that we have the same ownership group for American IRA, which is the administrator for your retirement account, as we do for our parent company, New Vision Trust Company, which is our custodian, and that's the company that allows us to be in business. So you have to have a custodian or a trust company to house, if you will, your IRA or 401k. And because we're fully integrated, what that means is that we're able to control our own destiny, and we're no longer reliant on a third party custodian or trust company to stay in business and kind of deal with the ebbs and flows of their business model and their interest in being the custodian for these alternative assets. So that gives us a lot of strength. So tremendous amount of credit is given to our founder, our principal, Jim Hitt, who went through a multi-year process, quite frankly, to create this New Vision Trust Company so that we could control our own destiny. Now, again, today is really very much about the apartment complexes. So we have a lot of content out there about how tremendous our fee structure is, how fair it is in comparison to our competitors in the industry. We talk a lot about our expertise and our knowledge about these asset classes, but I just want to make sure we have as much time as possible for Chris and his knowledge today. So as Chris is speaking to us about these apartment complexes and ways to analyze these and opportunities and structures for investing in apartment complexes, please try to keep in mind that any type of retirement account is eligible to invest in these real estate deals, whether it's apartment complexes, single family houses, etc. So anytime you have an old employer sponsored plan, like a 401k, a 403b, a thrift savings plan, that can be done by self-directing that, moving that account from your current custodian to a firm like ours at American IRA so that you can invest in an apartment complex, for example. And certainly any type of IRA can be self-directed as well, whether it's a Roth, a traditional, a SEP, a simple. For those of you that have inherited retirement accounts, or you have a Coverdale educational account for minors so that you can pay for their educational expenses, or a health savings account, all of these tax sheltered vehicles are eligible for these types of investments that we're going to discuss today. And so, as I mentioned earlier, real estate is certainly a big piece of our business model where clients are currently investing. And please keep in mind, any type of physical real estate can be acquired by your IRA or 401k. So anything from raw land to condos, townhomes, single family homes, commercial buildings, industrial buildings, apartment complexes, these can all be directly owned by that IRA or 401k. Now, typically what we see, especially with the larger investments, is that your IRA or 401k might be a member of a group. So the IRA or 401k is a member of a multi-member LLC, and that LLC will then go on to make the acquisition of an apartment complex, for example. So when Chris is speaking about these deals, it's very typical that on a 100 unit or a 200 unit apartment complex, that there is a group of investors, maybe it's 10 investors, maybe it's 50 investors, that have gotten together to become members of that LLC that will own that apartment complex. So just keep in mind there's a lot of different ways to structure these types of investments. Now, ultimately in the real estate space, the way that I like to describe this to people is that we're unable to use our IRA or 401k to purchase a primary residence or a property that will get personal use from, such as a vacation home. But there are a lot of investment strategies that we can utilize for real estate activity. So anything from purchasing rental properties to doing fix and flip deals. If you're working off market deals where you're wholesaling or you're putting options on properties, that can be accomplished with these retirement accounts as well. And as we mentioned before, joint ventures, which is really just an opportunity for your retirement account to be one of many members that will own an asset, and being the bank where your IRA or 401k is essentially acting like a Bank of America or a Wells Fargo and lending money to other real estate investors. So just to kind of give you the macro perspective of how I see these strategies for purchasing an asset. To me, typically a client, if they're going to purchase a piece of real estate, is going to fall into one of three fundamental categories. Many times we'll see an IRA or 401k that is the sole owner of the asset, and it's just simply going to pay cash for that property, whether it's land, condo, single family home, whatever the case may be. The second opportunity is where the IRA or 401k is going to partner either with other retirement accounts or other companies or other individuals, and there will be that joint venture type of arrangement that we spoke about, and they will then as a group go on to make the acquisition of the asset. And then the third opportunity is most likely what Chris is going to educate us on today, where an IRA or 401k is actually going to be borrowing money to make the acquisition of a piece of real estate. And so ultimately the key is that the debt that is being acquired, the debt that is being taken on for the purchase of this asset, needs to be non-recourse to these retirement accounts. So effectively what that means is that the IRA or 401k cannot be signing the debt associated with that mortgage. And so I'm sure Chris will at least allude to this on some level today, but that's why you have a group that is kind of leading this group of investors, these syndicators, these lead investors that are kind of putting together the debt instruments properly to kind of make sure that these more passive investors, like these retirement accounts, are kind of properly structured to be a part of these investments. So ultimately, there's a lot of different ways that your IRA or 401k can get involved in the ownership of a piece of real estate. And here we go. So ultimately, as I said, that's our part of the presentation. That's the self-directed concept and the fundamentals. And so again, we have with us today Chris Larson, who is an incredible resource, very, very knowledgeable. He's been involved in real estate in a lot of different capacities. And so I thought he'd be a tremendous resource to educate us today on how to analyze and how to think about apartment deals. So Chris, thanks again for joining us. I really appreciate this.
Sean, thanks for the kind words and the opportunity today. I have a lot of investors that have worked with your group and been very happy with the service that American IRA provides. So just to reiterate, we don't have any financial relationship, but really appreciate everything you do. And we also have, my wife and I, accounts with you as well, just in full disclosure. Today I'm going to be talking about moving from high income to high net worth using what I like to call the holy grail of real estate or multifamily to achieve financial independence. And if you want to learn a little bit more about my background, or you hear anything today and you want to dive deeper into the information, I'm going to put up a link where you can get a free copy of my book. You can download the ebook. If you put your address in, I'll send you a copy as well. Before we get started, as Sean mentioned, I'm not offering any securities today. I'm trying to flip my screen over here, Sean. Let me just make sure I'm doing this correctly. There we go.
Perfect.
So we're not going to be discussing any specific deals today. Not going to make any offers today. If you do like what you hear and you want to learn more, like I said, you can get a copy of our book at our website. You can also apply to become part of our investor club. We can set up a call. You can learn more about how to do that. So we're going to talk today about why multifamily, what are some of the benefits of multifamily, and I can answer some questions about what's occurred this year with COVID and how that's affected the space. We're also going to talk about specific multifamily investing strategy, as well as keys to success. So like Sean, I started off in the residential space. Probably a lot of people listening today have a good understanding of going out and buying a residential piece of property and renting it out. And I talk about that in my book. At age 21, I bought my first rental property, and that was boom, my introduction as an investor into real estate, and I did that for 15 years. But why I like multifamily today, after spending 15 years in a high stress professional environment in medical device sales, it's 100% passive the way we structure it. Number two, if you're high income, investors retain the tax benefits. Now, if you're investing through your IRA, you get a lot of benefits when it comes to taxes through that as well. But investing outside your IRA, there can be some great tax benefits as well. Again, as I say here, I'm not a tax professional. If you hear anything today, I highly advise you to talk to your CPA, talk to your other advisors, just to confirm that it does apply to your own personal situation. And here I say your investment returns scale. And what I mean is that over the period of owning multiple residential properties for 15 years, I bought my first property with less than $3,000 down. And when I sold it, I had about $100,000 in equity in that little property I bought. And what happened was my return on equity went down over time. And that meant I either had to buy more properties or I had to continually pull money out. And with multifamily, the nice thing is you can buy a 50-unit property and you can roll that investment through a 1031 exchange potentially into a 250-unit property. You can sell a 250-unit property into a 500-unit property, and it's still the same strategy. It's just a bigger property. And then as a bonus, and Sean touched on this, the debt is non-recourse. So for high income earners, people with high net worth, being shielded from that liability can be a real positive. So what do investors get in this asset class? They get cash flow, and that means that it's typically quarterly or monthly cash flow. You get appreciation. I'm going to talk about what I like to call controlled appreciation, and you get tax benefits. And I'm going to talk about how we acquire, ultimately improve properties by driving up rents, driving down expenses, and increasing value through net operating income, and then how we exit and sell these properties. So before I dive deep into how to create value in commercial properties, the difference between a commercial property and a residential property is that a commercial property is valued on NOI, which is net operating income. So my wife and I just sold a property about 2 years ago that we were living in, and it sold for about $300 a square foot. And the reason it sold for $300 a square foot is because our neighbor's property sold for $300 a square foot on our right, and our neighbors on our left sold for $300 per square foot. We didn't really have a lot of control over the value of that. A multifamily property is valued like a business. So what I like to tell investors is we buy businesses. The businesses happen to be real estate, which are apartment buildings, and we control the income. And when you control the income, you control the value of that property. So how do we do that? When we buy a property, we have rents at a certain level. And I don't know if anybody can see my cursor here. Yeah, there we go. So we have rents at a certain level and we have expenses at a certain level. So the goal is to increase the difference between rents and expenses, which is called net operating income. So how do you do that? Well, if market rents are above the rents that we bought them at, and you can improve operations, you can improve the exterior characteristics by injecting capital, spending money on things like landscaping, paint, roofs, the pool, as well as interior improvements, things like renovating kitchens, putting in hardwood floors. Our typical expense per unit is $5,000 to $10,000 per unit, and that allows us to raise rents to market levels. But then you still have expenses when you bought them. So our goal with our operating group is to, I'm sorry, I skipped over that part here, but I kind of talked through it there. So typically you can raise rents to market levels, and then if you make capital improvements, you can drive them even to a higher rate. So then the second piece of the equation is expenses. Our group's goal is to be the best operator in the space. And what that means is we can drive expenses down. Now, that doesn't mean we are letting things go to waste around the property. We're not making improvements. We're not slumlords. As a matter of fact, we're buying properties like the last one we bought was built in 2013. These are very nice properties that my wife, myself, our family would feel comfortable living in. Most people on this call would enjoy living in as well. However, there are efficiencies that can be had, and this might be operating more efficiently through less headcount. Maybe we automate certain things. One of the simple things we did at a property was we consolidated garbage and we consolidated dumpsters, and we saved about, several $100s a month. It translated into tens of thousands of dollars in value in that property. So as we drive expenses down through efficiencies, what happens is you have a net operating income that increases, and in most of our properties, we can increase this double digits. As you do that, you increase the value of the property. So then the second question is, if you understand that you can improve the value of a multifamily property by increasing income through capital improvements and decreasing expenses through operating efficiencies, why should we invest in the multifamily market in the first place? The multifamily market is fueled very simply by population and employment growth. And that means demographics. You want favorable demographics, which means you want people moving into the market. Supply and demand. I've written a blog post on this. We need about 4 million units this decade, 4 million units to be delivered this decade just to keep up with demand. So that's a nice market to be in. If you're in a market that needs more units and you're supplying those units, you're going to have a constant demand for your property. And then also the risk profile. So Sean touched upon this in the beginning of the webinar today. I'm sure a lot of people are listening and saying, I'm interested in using my self-directed IRA to diversify out of the stock market. I think the stock market is a great investment, but what we found is that if you look at high net worth, and I mean ultra high net worth families worth 30 million to 100 million plus in value, those families are investing somewhere around 30% of their net worth into commercial real estate, income producing commercial real estate. The question is why? And these aren't families that built their net worth on real estate. This is families that did not build their net worth in real estate. The answer is you're able to decrease the risk in your portfolio and increase the return, which is called the Sharpe ratio. Now, the downside of real estate, as most of you know, so it's a favorable risk profile, but real estate is inherently illiquid, which can be a benefit in a lot of ways when you have a market that's very volatile like we've seen this year. So let's look at demographics. Homeownership rates have been declining. They've actually gone up slightly. If you want to download my book, you can see a recently updated chart on the ebook here, especially this year as people have rushed to buy houses with coronavirus out there and low interest rates. But we've been in this downward trend of homeownership rates. And if you look at the developed world hovers somewhere around this 60 to 65%. We had this real bump for a lot of different reasons. I'm not going to get into all those different things going into 2006. And then we saw that big crash that came afterward. But people want to be renters. Who wants to be renting? So if you look at all age groups, we think, oh, young people rent, right? So 25, 30, 35-year-olds are out there renting before they go and buy a house. But what we found in recent history is that all age groups are renting. And if you look at the past 5 years, the fastest growing demographic of renters is actually baby boomers. And if you ask why that is, you say, oh, I'm renting as a baby boomer because I want to unlock the equity in my home and I don't want to deal with landscaping issues. I want to downsize. I don't need the space anymore with my kids. Maybe I want to travel more. So it's really interesting to hear and see the baby boomers following what younger generations have been doing. If you look at the long-term trend, this shows the increase here over the past decade, 5 to 10 years of renters in the 20 to 34-year-old cohort. Even though baby boomers have been the fastest growing cohort, the 20 to 30-year-old age group is going to continue and ultimately grow over the next 2 decades as well. I mentioned earlier, baby boomers are embracing the benefits of a multifamily lifestyle, and this shows up through 2015. This is actually accelerated over the past 5 years, and it's gotten even bigger as baby boomers continue to unlock the equity in their homes and continue to move into more lifestyle-friendly neighborhoods or lifestyle-friendly communities. So why should real estate be a part of a portfolio? I mentioned before, ultra high net worth families are looking to increase the returns of their portfolio and lower risk. If you see here, this is called the Sharpe ratio. So we're looking at a few different things here. Most people are familiar with large cap stocks, small cap stocks, corporate and government bonds, as well as commodities. On the y-axis, what you're looking at is the annualized total return, average total return, versus the annualized risk. And risk, if you want to think about it in a different way, is basically how volatile these markets are. So commodities historically have been very volatile. Stocks, small cap stocks, have been almost as volatile. Large cap stocks, less so. Corporate bonds and then government bonds. We consider government bonds to be the safest bet out there. But look at this. NPI, which is National Property Index, which is essentially income producing properties, have a similar risk profile to government bonds. Yet look at the return. They have a return profile that's similar to stocks. So what that turns out to be, if you look at the volatility in a different, sorry, this is a bar chart here of volatility. You're looking at REITs versus that direct ownership. So if you're thinking to yourself, why own REITs? I'm going to get the same reduction in my portfolio. It's actually not the case. REITs, if you think about it, are basically like real estate flavored stocks. You can trade a REIT in and out on a daily, hourly, even by the minute basis. And I know traders that do this. And the REIT, while it has to pay out like a property pays out, it's traded much like a stock. So it has very similar risk profile or volatility as a stock. But if you add actual your portfolio, so this is taking a look at portfolio A, B, and C. So if you have a typical stock and bond portfolio, your average return, and this was looking at a 20-year period from 95 to 2014, a little bit over 8% total return, standard deviation of 9.86. That's giving you a Sharpe ratio of 0.61. Look what happens when you add 20% to that portfolio. You add 20% to that portfolio, you increase the return, and you decrease the risk or the standard deviation, that volatility. And that yields a Sharpe ratio increase of about 25%. So 0.61 to 0.75, that's almost a 25% increase in Sharpe ratio. So if you're looking at this and thinking, well, that's not a real big increase in return. If I could tell you, I can give you a similar or even greater return and decrease the risk. Is that a good deal? This is what Ray Dalio calls the holy grail of investing. And that's why I stole his term and put it in my book and talk about multifamily being the holy grail of real estate. It's not sexy. It's not like, buying an IPO and talking about it at a cocktail party and saying, hey, you made 30, 40, or 50% in the latest IPO or trading in and out. But it's consistent. It produces annual income, and it produces controlled appreciation that can be a benefit to a well-balanced portfolio. So we've talked about how you can control the value of a multifamily property, how you can increase the value, what you get out of it with the cash flow, the appreciation, and the tax benefits. We've talked about the multifamily market as a whole. Let's talk about how do you find these properties? First off, we look at large and growing cities with job and wage growth. So we like big cities. We like the Southeast, first off. I moved from the DC area with my wife down to the Carolinas because of the demographic trends. I got into the medical device industry 15 years ago because of the baby boomers needing surgery. I still believe in those same things when I look for multifamily properties. We like cities like Atlanta, like Raleigh, Charlotte, Jacksonville, Florida, Houston and Dallas, Texas, Phoenix, Arizona. These are large growing cities that are outpacing the US national average in both job and wage growth, as well as population growth. Population growth is the lifeblood of a market. So if the country's growing at 1.5%, and you can be in a market that's growing 2 to 3%, you have a real rising tide in that market. But the challenge is relationships. It's still a relationship business in real estate. So when you're buying a single family property, if you know your neighbor's selling that property, you can get it off market, you can get a better deal than if you buy that in a general listed or under a MLS listing that's out there. It's the same thing in the multifamily space. Before we even look at a deal, we're going into these markets with high population, job and wage growth, and building relationships with owners, with sellers, and with brokers into these markets. At that point, we start to dive deep. We dive deep into the submarkets. We look at different neighborhoods. We're looking at financial analysis of these properties. If we have a property that's on the market, we're on site. We're doing property tours and inspections. If anybody says, how on earth do you do that during COVID? I can tell you, you have to get creative. We use a lot of virtual technology. We use drones. We have small teams that go on site taking proper precautions, and technology has been amazing. It's been amazing for our team in the past, and it's really allowed us to continue to do due diligence and look at properties. We also do tours of competing properties. So we go in and when we say go shop, we look at other properties in neighborhoods that are close by and say, hey, is this a good market? What are other neighborhoods getting in terms of rent, and how are they running their properties? And then financial modeling. You know, you can look at numbers on a spreadsheet, but you have to blend those with boots on the ground and operating knowledge as well. And that's what asset management is about. You have to take a top-down approach. When we buy a property, we're going to look at not just what in-place rents are today, but we're going to look at what rents would be if we spent money. So as I mentioned earlier in the presentation, if we're buying a property and spending $150,000 a door, we may go in and spend another $7,000 per door after we buy it. That means we have to raise that money from our investors to make those improvements. And some might say, well, if you're buying these properties, why would somebody sell if it's such a great investment? Well, the answer is if you have a property, you have a 200 unit property, and it's increased in value by 50% while you held it for say 10 years, maybe you don't want to spend $1 million or $2 million in that property to bring it up to market value. Maybe you want to take your money and just buy another property that you can run like you were doing that's a little newer. So what we do is we buy properties that have the opportunity for what we call value add. We want rent growth. We want the ability to bring rents up. Property we bought in Raleigh last year in the Research Triangle, rents in that property were right about $1,000 a month on average. Market rents were $1,250. So that's a 25% difference in markets. And then vacancy optimization. If we buy a property, if it's 99% occupied, we say that's an opportunity. People say, well, isn't that good to have your property 99% occupied? You want to optimize the vacancy to increase the income. So you may want a 5% vacancy because that's going to allow you to continue to push rents. So some people may move out, but you can continue to move rents up to market, and you may actually make more money with a 95% occupancy than a 99% occupancy. And then tax optimization. One of the neat things you can do in this space that's not always available in the residential space is what's called a cost segregation analysis. What that means is you can go into a property that's 200 units, and the IRS allows you to depreciate things like washers and dryers, dishwashers, other appliances, fixtures, even landscaping at a faster rate than the typical 27.5 year straight line depreciation. And I talk about this more in my book. We can talk about it in the question and answer session or offline. But what that means is we can typically offset all of the income that we're paying out to investors by depreciation. And some of our investors are even getting up to 90% year one depreciation on what we buy. Again, it depends if you're using an IRA or outside. Maybe that doesn't matter to you. Maybe you're getting all the tax benefits in your IRA and you say that doesn't matter to me. But it is something that is fairly unique to what we do. And then we have a hands-on approach. We have a full-time asset management team. We're doing weekly calls with staff. We're doing announced and unannounced visits. We mystery shop. I mentioned that before. We go in and mystery shop or ghost call our neighboring communities. But we also want to do the same for ours to make sure that our teams are running as well as they can. And then investor communications. I do a monthly newsletter and updates to our investors. Our group actually distributes dividends monthly instead of quarterly, so you're getting constant monthly updates, and then you get all your quarterly financials as well. And we hold investors very high. As if you go to my website, you'll see we put investors first, and we hold that true with our communications as well. So how do you actually make money? So this is great, Chris. You know, we talked about theoretically how you do all this. How long do you hold the property, and how do you get your money back out of the property? Typically, when you see one of the investment properties that we bring to our investors, it's going to have a hold period of somewhere between 3 and 7 years. And what I did here is I showed this is an increase in value. And if you look at this, if you're an engineer like me, you're thinking of the area under the curve. What we want to do is we want to hold the property while we can increase that income. And then as that income increase starts to peak, or I'm sorry, that income increase starts to peak, that means the value appreciation curve, or the speed it increases, has started to peak. This doesn't mean the property's gone down in value. It means the rate that we're increasing the property in value has slowed. And this period out here is when income typically has increased, but we're not really increasing the value that much. So what we look to do is, after we've increased the value, we want to start to think about marketing that property so that we can perform our strategy all over again. And that typically is going to occur around 3 to 7 years after we've increased the value through that controlled appreciation of capital injection and operational efficiencies. So how do you get your money out? You can refinance it. We actually call that a supplemental loan. So just like if you bought a single family home for $200,000, let's say you put $50,000 in it to improve it, and now it's worth $300,000. You could go to the bank and say, hey, I want to do a cash out refinance and take out 80% of my money. Okay, you could do something like that. You can add some debt to it, pull money out, and return that to investors. Or you could just sell the property. So you could sell that, and typically when we sell a property, we're going to look to do a 1031 exchange, again, to optimize the tax benefits of this strategy. So if you have a $100,000 investment that's now worth $150,000, you can take that $150,000 investment through a 1031 exchange and roll it into a new property. If you're getting a 6% cash return on that property at $100,000, it's $6,000. If 5 years later it's now worth $150,000, now you're getting $9,000 a year. So your income has increased 9%. Through a 1031 exchange, you can prolong taxes potentially indefinitely through that. So we're always going to consider that option for our investors. So what are the keys to success? I mentioned relationships earlier. It's hard to do this as an individual. I can tell you, I started as an investor in this space in 2013 after 15 years of owning single family properties. And then 2 years later, I formed a partnership with my original partner. And in 2016, we syndicated our first deal. And what we did was we did a co-sponsorship with the original group that we invested with, because they had relationships that we were able to leverage and ultimately improve upon in the markets that we were focused on. 2, you need capital. The last property we bought was $49.9 million. And what I can tell you is I don't have the cash to go and buy that property by myself, but through syndication, through partnering with other investors. We invest in all of our deals personally. We typically are bringing about 10% of the cash, my partners and I, to each deal, and the rest of the 90% is coming from our investment side of us. And through that capital partnership, we're able to buy these large apartment complexes that are of institutional quality. And then experience. I've been doing this over 20 years. I bought my first property in 1999 at age 21. 42 years old now, which is maybe why my tongue doesn't work as well as it used to. I'm stuttering here a moment. But all my partners have been in this space. We have multi-decade experience, and that goes in the operational space, the financial evaluation space as well. So again, just to recap, if you're saying, as an investor, why should I do this? It'd be the same reasons probably why I started investing in this space back in 2013. It's cash flow, typically tax advantage cash flow, appreciation, as I mentioned, what I like to call controlled appreciation, and ultimately the great tax benefits that can be had through many forms of real estate. But in my opinion, unparalleled with multifamily real estate. So again, if you're interested in learning more about what we do, please check out our website, nextlevelincome.com. We have a podcast that we put out bi-weekly. We do a blog as well. So tons of free resources up there. We love to share what we do with investors, whether you're investing with us or elsewise. I just published an updated version of my book that came out in March on Amazon. You can certainly go to Amazon and get it. But for anybody on the call today, if you like what I have to say and you want to learn a little bit more, check out the link that I just posted in the chat box. It's nextlevelincome.com. Click on the book link and you can get a free ebook, and I'll even send you a free copy if you put your address in there. I really appreciate everybody's time today. I wish everybody the best during this period. I hope you stay healthy and happy. And Sean, if we have time for questions, I'm happy to stay on and listen to them.
Perfect. Thanks so much, Chris. That was a lot of good stuff there. And so yeah, as Chris said, so here's the book. I've read this. It's a really good read. Chris keeps it clean. It's understandable language, but I actually I emailed him. I had a number of notes of things I actually took from that, and yeah, it's definitely worth your time, effort, and energy to dig into that. So without further ado, we will go ahead and open up the questions box here. Okay, so obviously a few of them have come in already. Feel free to keep typing in if you're listening to this live. The first question, I'm assuming they're probably all going to be for Chris. Chris, what cap rate are you purchasing properties at?
Great question. So we have purchased properties anywhere from around 5% up to north of 7%. And I'll also add a follow-on answer to what would be a follow-on question. You may say, well, is it better to buy at a lower cap rate or a higher cap rate? And the answer is, it depends. So if you're buying at a 5 cap, that means for every dollar increase in value, you are increasing the value of the property $20, if that makes sense. So you're taking $1, you're dividing it by 0.05 or 5%, and that means a $20 increase in value. So you can see how, a little dinky, $4,000 savings on a couple dumpsters can lead to an $80,000 increase in value in a 5 cap property versus a 7 cap property. If you buy at a 7 cap and you increase $1 in income, you're leading to it's around $15. I think it's like about 14 and a quarter dollars in value. So depending on the type of property, typically we're buying heavier value add properties at the higher end of that range. What I mean by heavier value add, that means we're typically spending more money per door to increase the value or the income of that property. Whereas the properties we're buying on the lower end of that range, around that 5.5 cap, we're not spending as much per door. We're relying more on operational efficiencies for those properties to drive value. And what we're seeing is, regardless whether it's a 5, 6, or 7 cap, we typically, depending on the strategy, can yield about the same IRR, total returns to our investors.
Perfect. Awesome. All right, so the next one is, how do you feel about the Tampa, Florida market over the next 10 years?
I know Tampa. I don't know it very well, frankly. So Tampa is on our radar, but it's not been a market that we have targeted. If there's a specific investor, you can email me and we can set up a time to go through some of the more specifics in that market when I can circle back on it for you. But it's not, frankly, it's not on my radar at this moment.
Okay, perfect. Chris, do you recommend a property management group for the non-landlord investor?
Oh, great question. So it depends. The answer is it depends. We use third-party property management. So if you read my book or you look at some of the slides we have up, you would have seen the the title of asset manager. So think of an asset manager of a manager who manages the managers. That's a mouthful, right? So a property manager is going to be the one that's on site every single day. They're going to be leasing units. They're going to be walking the property. They're going to be coordinating improvements. The asset manager, who's part of our team, is going to be the one that is putting together the strategy, and they're the ones who are watching the investors' dollars. So what we do is in every market we go into, we find the top 2 to 3 management companies for the types of properties that we're looking for. So you can imagine a property that's what we would call an A property, maybe that's built in the last 5 to 10 years. It's going to have a different resident population and a different management need than a property that's built in 1975 that may be in a lower income area. So if you have a specific market that you're talking about, I'm happy to refer you to some management groups because what works in Atlanta in a 1973 property that we're sinking $10,000 a door into is going to have a different management need than a 2013 property in the heart of the Research Triangle of Raleigh.
Perfect. Great. So the next question revolved around your book, Next Level Income. So that's why I popped this slide back up. So for those of you interested in jotting that down, and as Chris mentioned, if you can see the chat feature on the GoToMeeting tabs, it's at the bottom. There's also a link there as well. So Chris, how can I research syndications?
I would just type syndication into Google and you can learn about that. Essentially, a syndication is taking a property, taking an offering and sharing it with a group of investors. So like I said earlier, the way we view it is we invest alongside of our investors, but what we're doing is we're taking a property, we are forming an LLC. So if you're an investor with our group, and you said, hey, I heard you guys are, you have a property that you're buying, what we would do, let's say it's at 123 Oak Street, we may form 123 Oak Street LLC, not much different than if you went out and bought a single family property. The difference is instead of maybe just yourself owning that LLC, we may have 100 different investors in that LLC. So what we do is we form the LLC, we offer it to our investors through a syndication. Those investors fund the deal, put the money in the LLC. We then go out, we typically get what's called agency debt through Fannie Mae or Freddie Mac, or preferred lenders. That's going to be that high quality, low interest rate, non-recourse debt. And then we're going to buy the property. And I like to call the loan company, or the mortgage, Fannie Mae or Freddie Mac, our biggest investor, because they're coming in and they're doing their own research and validating the price that we have it. So there's a ton of information on syndications out there, but for layman's terms, that's how we do it.
Perfect. And so there are actually a number of questions revolving around the debt. Is there any sort of just kind of general structures you could give us with terms, length of term, et cetera, that you could share?
Sure. So as I mentioned before, we're typically using what we call agency debt through Fannie Mae or Freddie Mac. The government loves this type of loan because they want to increase the amount of housing that's out there. So they love what we're doing and they want to encourage more of it. So we're typically seeing, like right now, we're seeing rates very similar to mortgage rates in the housing industry, 3 to 4%. The last property we closed on in May was right around 3.6%. And that was 10-year debt with, it was 5 years of interest only. So, we're getting 10-year debt in the threes, non-recourse with 5 years of interest only. That's pretty typical for what we're seeing right now. If anybody has any questions about loan to value, we're trying to optimize that around leverage and returns. We like leverage rates around 70 to 80% of the property, and that's also going to depend on how much additional capital are we raising for capital improvements, which is also going to kind of affect the total investment to value ratio, if you will.
And so when you say 10-year debt, Chris, are you speaking about the total amortization length, or is that the call date, or how does that work?
Thanks for allowing me to clarify. So typically it's amortized over 30 years, but it's going to have a balloon or a refinance event at 10 years out.
Great. Perfect.
And that's in general. We do from time to time look at bridge debt. We look at different structures, but kind of the overall rule is that if we have a hold period of say 7 years for a property, we're probably going to put 10-year debt. If we have a hold period of 3 years, it might be 5 or 7 year debt. So we always want our debt to outstrip the hold period, so we're not in a position where we're being forced to refinance or sell that property, if that makes sense.
Okay, great. If you have time for a few more, we do have a number of questions. I'm
Absolutely.
trying to consolidate these here. What would be the typical IRR for the investment?
Yes, I'm always careful to talk about returns because every deal is different. So, every deal is different. We don't do a fund, so we're not going out and saying, hey, we're going to give you, a 10% return. In my book, I have some models. I talk about a 5% cash return, a 12% total return. I'm comfortable putting those numbers in my book. If you want to look at specific deals as a potential investor, like I said, I encourage you to go to our website. You can click on the invest button and put your information in there, and I can give you some more specifics. But looking at cash returns in the mid-single digits and total returns in the low to mid-teens is a reasonable range to expect in this asset class.
Okay, great. So what is the sweet spot for the number of units for a complex, in your opinion?
Oh, this might be my favorite question yet. So it's a real balance. So, a lot of investors, they call me and they say, hey, I'm going to buy a 25 unit property. I'm going to work up to like a 250 unit property. And the thing is, it does not have to be linear. So if you look at the sweet spot, typically around 150 units, you're going to get to the point where you can optimize your head count for different positions. And what I mean is, if there are any business owners listening, or any employees for that matter, you can't split a person in half, right? So if you hire somebody full time, then they can do up to so much work. So you want to optimize, the full-time employees per role, or you want to have multiple communities in a market that's going to allow you to do that. So typically 150 units plus is where you really kind of hit the sweet spot. Then you have to ask yourself, all right, what environment are you playing in? If you're, you can buy 10 to $20 million properties. They're going to be out of the range of mom and pop owners, but maybe under the radar of institutional companies. When you get into, some of the properties that we've acquired recently, like I mentioned, the last one at almost 50 million, you are competing with large, sometimes institutional buyers. And, we've been buying properties north of 200 units. And when you get into that space, you can really see your operating expense ratio, which is the percentage you're spending on operating expenses as a total of income, go down. And if you run a really well done property, you can see that as low as around 40%, versus some smaller properties, it's more like 50% or higher.
That makes sense. Okay, so two more. Is there a minimum portfolio size required in order to invest in real estate as you've described, either through a REIT or other structure?
Yes, if I understand that correctly, do you need an amount, in your net worth, your portfolio to take advantage of this space? I think that's understanding it. So I'll address it in a couple different ways in case I'm not getting that perfect. So if you're starting out and you say, well, I can't invest enough in one of these deals or diversify into these deals to make it make sense for me, reach out to me. There's some companies that offer, low minimum investments, even in the hundreds of dollars to kind of have access to this space. It might not have quite the same benefits or returns, but if you want to diversify, I can certainly point you to some resources there. Our minimums are typically $50,000 in this space. So, we have our typical investor is putting, somewhere between $100,000 and $500,000 in this space. So if you look at that as a percentage of a portfolio, if you're listening, for you, that might be one deal. I have investors that they're investing, their goal is to invest in 2 deals a year for the next 10 years. And a lot of investors are looking at that through the lens of, my goal is to replace my active income with passive income. If you're looking at for portfolio diversification, you may say, I'm going to take a chunk, 25% of my portfolio, for instance, and I'm going to invest it over, 2 to 5 deals. And like I said, it just depends on your goals. But if those numbers are high for you, there are other resources out there that I can point you in the direction of.
Fantastic. And so the last question, I'm just going to kind of rework a little bit to make it more generic. So typically, Chris, obviously, as you said, you're plugged in with a lot of entrepreneurs and investors in the apartment space. Is there a typical structure you see in terms of payouts to the investors annually, quarterly, what have you?
Yeah, so we, I've seen a lot of different structures. I think the way our group does it is favorable for investors. So what you're typically going to see in this space is you are going to see quarterly or monthly payout. So if you have a 6%, and I'm throwing out numbers here. These aren't promised returns, but if you have $100,000 investment that's paying a 6% effective dividend on the income in that property, that's $6,000 a year. If it's quarterly, you'd be getting a $1,500 check. If it's monthly, it'd be a $500 check. And then if there's a refinance event, investors are going to get one big check for that. If it sells, they'll get the return of their capital at that time, or they'll typically have the opportunity to roll that into another investment. Our group typically offers 2 different structures for investors. They can elect to invest in basically a fixed return, which we call Class A, or a return that has a income component and an upside equity component on the backside, which we call Class B. And then for those investors that are familiar with it, and I'm actually have an upcoming blog post on this topic. So if you say, hey, I'd like to learn more about that, you can shoot me an email, or you can subscribe on our website to our podcast and our blog. But it's called a preferred return. So typically our investors are getting the first 6 or 7% of the investment before there's any participation by the GP partners. So we protect our investors by giving them that first portion of the return, and encourage us to make sure that we're putting our investors ahead of us before we even get to participate in the upside.
Kind of the old school Warren Buffett partnership model there. I like that. Interesting. Okay, great. Well, a lot of great questions here. Again, I really appreciate everyone's time and attention and thoughts and questions. Chris, again, just a lot of great information. Thank you so much for taking time out of your busy schedule to educate us and kind of bring us up to speed with this asset class. Any final thoughts or anything you want to share?
Sean, just again, thank you for the opportunity. Thanks for everyone's time today. I hope I provided value to you. If you want to learn more about what we talked about, please get a free copy of my book. Reach out. My email, as it's here on the screen, is chris@nextlevelincome.com. I respond to every email I receive. Might not be within the hour, but I promise I'll get back to you. And again, Sean, I really appreciate all the value you provide to your clients. And we've been working with you guys for a long time, and I know we refer people to you because we appreciate the value that you provide in the service.
Thanks so much, Chris. Yeah, you've been great, and again, you've been been a tremendous resource and mentor to me over the years. So thank you all so much. Hopefully we can see you again at another webinar, and hopefully at some point in the future we'll be able to have live events and what have you as well. So thanks again,
Look
Chris
forward to that.
Larson. Absolutely. And we'll see you all soon. Thanks so much, everyone. Have a great day.
Thanks, everyone.